Hello everyone, today we'll be going over the Accounts Major 2021, Paper 1-2. This is a multiple choice paper and we'll have 30 questions and the time limit is only 1 hour. Alright, let's get started. In the first question, we can see which of these items require entries to be made in the General Journal. We have the first item, the purchase of non-current asset on credit. So the thing here is that we're purchasing a non-current asset. If it were to be a purchase of goods or purchase of inventory on credit, it would have gone to the purchase journal and not the general journal. But since it's a purchase of non-current asset, it definitely comes under the general journal. And the item 1 will be recorded in the general journal. Now, the item 2 is the sale of inventory. So right now, it's the sale of inventory or a sale of goods, and always these comes under the sales journal, not the general journal. So the item 2 is not included in the general journal. In item 3, we have the honor taking drawings. So drawings is always a contra and it does not come under the general journal. So item 3 is not included as well. And the fourth one is the writing off an irrecoverable debt. It's a bad debt, right? And bad debt comes under the general journal. So item 4 is also included. So the items that are included are item 1 and item 4. And it's given by our option B, which is the correct answer. Let's move on to question number 2. Which statement relating to depreciation is not correct? So we need to find out the 3 statements which are actually correct, and then we need to find out the 1 statement which is not correct, and that option will be our answer. So let's look at the statement A. A business can never change its accounting policy on depreciation. This statement is not actually true. So what happens is you cannot change accounting policy on depreciation frequently. So you cannot change it every year, but after passes of few years, you can actually change the accounting policy. So option A is incorrect one, which means that option A is our answer. But let's also look at option B, C, and D. B states that depreciation is the allocation of the cost of a non-current asset over its useful life, which is absolutely true. So B is the correct statement, right? And then option C states that freehold land is usually not depreciated, which is also true. We don't depreciate freehold land. Freehold land are sometimes actually revaluated upwards. So option C is also correct statement. In option D, we have non-current assets of similar class are depreciated using the same method of depreciation, which is true. You cannot use different methods of depreciation for the same or similar non-current assets, right? So our correct option is going to be option A. Let's move on to question number 3. We have Arnaud, who owned a vehicle which originally cost 20,000. All right. And then during the year ended 31st May 2021, he paid for repairs 3,700 and provided depreciation of 4,000. And then on 31st May 2021, the vehicle had a net book value of 12,000, right? And then Arnaud sold the vehicle actually, all right? And he incurred a loss. So the loss on disposal is given and the amount is 2,500. Now we need to distinguish the cash inflows and the outflows. All right, now the first one is the repair. So repairment cost, right? So repairment cost of 3,700 is actually paid. So when we pay something, the cash goes out of the company. So cash outflow is actually 3,700. So I'm just going to write it here. And provided depreciation. We know that depreciation is an expense, but it's not necessarily a cash expense. So depreciation is a non-cash expense, so it does not result in any changes in the cash flows. So the only change in the cash outflow is of 3,700, which is given in the option A, right? But let's also look at the cash inflow. Now he had the net book value. So net book value was of 12,000 and he sold the vehicle at a loss. So what loss means is that he sold the vehicle in less than the net book value. How much lesser than the net book value? That's given by the loss amount. So then sales value was actually 12,000 minus 2,500. Since it's a loss of 2,500, we're subtracting it. But if it were to be profit, we would have added it to the sales value. All right. Now the total sales is actually 9,500. right, which is also given by option A, which suggests that option A is our correct option for question number 3. Now question number 4, we have a business who purchased 2 machines costing 25,000 each. So the cost of one machine is 25,000, means that the cost of 2 machines will be 50,000, right? Then during the third year, one of them with a net book value of 16,000 was sold. Okay, since one of them with the net book value, but what we also know is that both of the machines costed the same value. It means that the both of the machines have a net book value of 16,000 on the third year. Okay, now we have a new machine costing 30,000 was purchased. So this is an addition, right? Okay, let's calculate the net book value on the third year. So I'm just going to write NBV. We have 16,000. So one of the machine is already sold, right? So then 16,000, we should not be including that value. We should only be including one of the 16,000s, and the other machine is actually sold. So we do not have that under our authority, or it does not come under our asset now. And then we also purchased a new machine which costed 30,000. So we're just going to add it. And then the total net book value will be of 46,000 actually. All right. Then the depreciation is charged at 20% per annum. Okay, you might have a little bit of confusion here because I wrote net book value, but I also added the cost, right? But this cost is of the first year because we're only purchasing this asset or the machine costing 30,000 on the third year. So whenever we're purchasing a new machinery, the cost automatically becomes the net book value because we do not have any accumulated depreciation. So the accumulated depreciation is actually going to be 0, which means that the cost will be equal to the net book value. That's why this is actually correct. All right. Now the depreciation is charged at 20% per annum using the reducing balance method. So reducing balance method means that we need to charge this 20% to the net book value and not to the cost. And we already have the net book value, so we're just going to charge the depreciation now. So depreciation is 20% of the net book value. So that's just 46,000 into 20%. And we get the value of 9,200, which is given by option B. So our correct answer is option B, which is the depreciation charge for the third year. Okay. Now we have question number 5. Which statements about an unpresented check are correct? Okay, it arises as the result of an error of omission. Okay, what is error of omission? Whenever there is a transaction, right, but the accountant or the business owner forgets to record it, that's the error of omission. An unpresented check is not an error of omission. So option 1 is actually not true. Then option 2, we have it arises from a timing difference, which is absolutely correct. And statement 3, we have it is used when preparing a bank reconciliation statement, which is actually true, because while preparing a bank reconciliation statement, we need to balance the total of both the bank book and the cash book. So statement 3 is correct. Then 2 and 3 is given by option C, which is our correct answer. Now let's move on to question number 6. All right, the balance on the purchases ledger control account did not agree with the total of balances from the purchases ledger accounts, and the following errors were then discovered. Now, what the question asks is, which errors will require entries being made in the purchases ledger, right? Okay, the first one is the contra entries had not been entered in the general journal. Now, in order to correct this error, we need an entry to be made in the purchases ledger. So 1 is correct. And then the error 2 states that debit balances on the purchase ledger had not been included in the control account. This does not require any entries to be made in the purchases ledger. So we're just going to cross that out. The third one is discount allowed total had been included in the control account, which is actually true. Discount allowed is actually included there, which suggests that no entries need to be made in the purchases ledger. And then the fourth one is that the goods returned to a supplier had not been recorded in the purchases returns journal. So this actually requires an entry being made in the purchases ledger, so we're going to include this. So the errors that need to be considered are error 1 and error 4, which is given by option D. That's our correct answer. Let's move on to question number 7. Here, the correction of which error requires an entry in the suspense account? Okay, the first option is a check 1,000 which is being paid, all right, to Kong had been debited to Kang's account. When is an amount debited? So debit is always expenses, right? And this is also paid, so which means that a check which actually was to be paid to Kong had been paid to Kang's account. But regardless, the check has been paid, right? The payment has been made. So we do not actually need any suspense account over here. So option A is not the correct answer. Let's look at option B. A purchase of stamps of $50 had been debited. Again, debited, so it's expense, and purchase is also actually an expense to the purchases account. Okay, here it's an error as well, because purchases account only include the purchase of goods or inventory, but here we're including the purchase of stamps as well, which is an error. But regardless, it is a purchase, right? So expense has been debited, so it does not actually require any suspense account. So option B is incorrect as well. Option C is commission income. This is an income had been debited. So income can't be debited. Income actually need to be credited. And obviously to settle this, so the income had to be actually credited, right? But it's debited. So in order to settle this error, we actually need a suspense account. So option C will be our correct answer. But let's also look at option D, the insurance account. So insurance is also an expense, right? Had been undercast. Okay, this had been undercast by 200, and wages, which is also an expense, overcast by 200. We can see here that the undercast and overcast is of the same amount, which is $200, right? So we just only need to change the heading over here. So we need to add 200 to insurance and deduct that 200 from wages. So regardless of that, the total amount will not be changed. That's why option D does not require any suspense account. Hence, the correct option is option C. Now, for question number 8, a business had a draft profit of 200,000, and then the following items had been discovered. Depreciation had been overstated. Okay, what do we need to find is the correct profit. I'm just going to get started on that. So the correct profit, let's just start from the draft profit. So 200,000. We're just going to make the amends to this amount, right? Now, depreciation charges had been overstated. So, which means that I need to reduce the depreciation charge by 20,000. But if we remember the format of the income statement, depreciation is an expense, right? So it's already going to be reduced in order to get this profit amount. But if I also have to reduce the depreciation amount, then that's going to result in just double negative, which will be positive. So I'm just going to add the 20,000 here. I hope you got this. It's just that depreciation is already reduced. But again, I need to also reduce the depreciation amount. So that's just double negative, which results in a positive. So I'm just going to add that over here. All right, the second one is the value of the closing inventory was again overstated. So I will again have to reduce the value of closing inventory. Now, if you remember the format, closing inventory is actually added when finding out the profit. So if it's plus, and it's overstated, right? So I'm gonna have to reduce it, and plus and minus is just gonna be minus. So I'm just gonna reduce this amount, 15,000. And the third one is a year-end accrual for wages. So accrual, what's an accrual? Accrual is actually just the outstanding, and we're talking about wages. So it's an outstanding payment, right? So outstanding payment need to be paid in this year. So I'm just going to have to include this 8,000 in my expenses. And expenses are always negative, right? Because we reduce the expense in order to get the profit. But I'm going to include this or add this to the expenses. So that's just plus. And minus and plus is going to result in, sorry, that's wrong. Minus and plus is actually going to result in a minus again. So I'm also going to deduct 8,000 from here. And in number 4, we have a year-end adjustment for prepaid insurance. So prepaid insurance is not actually an expense for this year. It's going to be an expense for another year, right? So this should not be included. It's an expense, So that's a negative, but it should not be included. So I'm just going to have to deduct this amount as well. And deduction just means minus. So minus minus is going to result in a plus amount. So I'll just going to have to add 2500 over here. Now if we calculate these amounts, we get the value of 199,500, which is given by our option B, the correct answer. Okay, let's go to question number 9. A trader purchased fixtures and fittings. Okay, what's the fixtures and fittings? Fixtures and fittings are non-current assets, right? On credit. So meaning whenever it's on credit, we have a personal account also involved. So here the personal account will be that of a supplier. And these were faulty and were returned to the supplier. All right, so it's actually a purchase return, right? We bought in the non-current assets. So if we're gonna bring something in, then the non-current assets increases, right? So when we purchased it, it would actually be recorded on the debit side, account to be debited, but we're returning those. While we're returning those, the non-current assets actually decreases now, right? And whenever the amount of assets decreases, it always results in the account to credit. So on the credit side, we're going to have now fixtures and fittings. So that's given by option C and D. Now we also have to look at the account to debit. And the key here is this credit thing. Because like I said before, whenever a transaction is done in credit, it always involves a personal account, right? And the account to credit is already fixtures and fittings, which is not a personal account. So we need a personal account on the debit side, but purchases returns is not a personal account. But supplier is actually, in fact, a personal account. So the correct answer is just going to be option D. So let's look at question number 10 now. We're given sales of a sole trader. All right, so sales, we have opening inventory, we have closing inventory, and we have gross margin, and we need to find the purchases. This is quite easy. So let's first figure out the gross profit. So gross profit is just going to be 25% of sales. So that's just 200,000 into 25%. So this is actually only 50,000. Now we know that sales, I'm just going to denote it by S, minus cost of sales, I'm going to denote it by COS, is actually gross profit, right? And we already have the amounts for sale, which is 200,000 minus cost of sales, and then gross profit is 50,000. So from this, we can figure out that the cost of sales is actually 1,50,000. Great. Now we need to find the purchase. And we know that the formula for cost of sales is just opening inventory plus purchase minus closing inventory. So this is going to be the total value of the cost of sales, which is 1,50,000. And we have the opening inventory of 50,000 plus purchases minus closing inventory is 75,000. And the total is 1,50,000 again. Now this is a very simple equation. Now purchases is going to be 1,50,000 minus 50,000 and plus 75,000, which is 1,75,000 given by option C. That's the correct answer. Now question number 11. Which item would not appear in the financial statements of sole trader? Okay, the first option is bank overdraft. Bank overdraft can appear in the financial statements of sole trader because bank overdraft is just something which occurs when you're issuing a check with an amount higher than what you have in the bank account, which can occur to a sole trader, right? So A actually appears in the financial statements. Now for option B, we have dividends paid. What is dividend? So dividend is a type of return that shareholders get in a company, but we're talking about a sole trader and not a company, which means that there are no shareholders in a sole trader, so dividends need not to be paid. So option B is not included in the financial statements, which is the correct answer. But let's just look at options C and D as well. We have interest received. Interest can be received by a sole trader, right? He can give loans to somebody and he can receive the interest on that, so it can be included. Third, and the last one is loss on disposal of machinery. A sole trader can actually get rid of the machinery and incur loss in that. So D is something that could actually appear in the financial statements of a sole trader. So we're going to stick to our answer B. Okay, question number 12. We have partners L and M who are sharing profits and losses equally, right? And then M's share of profit is 18,000. Since they are sharing the profit and losses equally, L's share of profit is also 18,000. Okay. Next year, they plan to change the partnership agreement so that L has an annual salary of 10,000 and a 1/3 share of the profits or losses. So if L is getting 1/3, then M will be getting 2/3 of the profit or loss. Now, what does the total partnership profit for the next year need to be for M to receive the same amount of profit as this year? Okay, I'm just going to denote the total partnership profit as X. And M's share of profit should be equal to this year. So this year's share of profit is 18,000. And I denoted X as the total partnership profit. And we need to deduct L's salary, which is 10,000. And M is only liable to 2/3 of the profit. So I'm just going to multiply by 2 by 3. Now this is a very simple equation. So X is just going to be 18,000 into 3 by 2 plus 10,000. So what's the value of X now? We can calculate it quite easily. So the value of X is going to be 37,000, which is given by option C. And here X is the total partnership profit, which is 37,000 given by option C. So that's the correct answer. Okay, we have question number 13. It's also a partnership question. V and E are in partnership, sharing profits and losses equally, and their capital accounts have V has 80,000 balance and E has a balance of 40,000. Okay, and Z was admitted as a partner on 1st April 2021, and at that date the following items were taken into account. So non-current assets were revalued downwards, which means that there's a loss on revaluation. And then goodwill was valued at 80,000, but will not remain in the books of accounts after Z is admitted. And we are also given the new profit sharing ratio. V has 40%, E has 30%, and Z has 30%. Now we need to find the balance on E's capital account after the admission of Z. So I'm just gonna make the capital account for E. I'm not gonna write all of the headings, I'm just gonna include the amounts. And that's what you guys should be doing in your exams as well, because it's only 1 hour. Now we have the credit balance of 40,000. So this side is credit and this side is debit. Okay, so balance is actually 40,000. Then we have a loss on revaluation of 20,000. And the profits and losses are shared equally, right? So loss on revaluation for E would be exactly half of 20,000, which is 10,000. And since it's a loss, we're going to record it on debit side, because all the things that decrease the capital amount will go to the debit side. All right, next we have goodwill. So goodwill before that was admitted, 80,000 would just be divided into 2 equal halves for E and V, right? So that just means that 40,000 would be the old ratio. But the new ratio, we're going to have only 30% of 80,000, which is actually 24,000. So this is the new ratio. So let's just total. So here we're going to have 80,000. We're also going to have 80,000 over here. And the balancing factor, this is balance, would actually be the E's capital account, which is required. So let's just balance it. So it's just going to be 80,000 minus 10,000 minus 24,000, which is given by 46,000. Our option B, that's the correct answer. So question number 14, which account is used to calculate the profit or loss on the dissolution of partnership? Okay, we have appropriation account. Appropriation account is something that records interest on capital, interest on drawings, partner salaries. So it's not going to calculate the profit or loss on dissolution. So A is not the correct answer. B, we have capital account. Capital account actually records the amount of the partners' capital balances. So again, it's not going to calculate the profit or loss on dissolution of a partnership. Realization account is the one which actually calculates the profit or loss on dissolution of a partnership. But revaluation account is made when there is a new addition of a partner or an existing partner decides to leave the partnership. So this is not true. So the correct answer is just going to be our option C. Okay, let's look at question number 15. Which statements apply when a bonus issue of ordinary shares is made by a company? Okay, it will be made to existing shareholders, which is actually true. Someone who does not hold any shares of a company cannot apply for a bonus share. So bonus share is actually given to the existing shareholders. Statement 1 is correct. Statement 2, the issue can be at a premium, which is wrong. Bonus issue can never be at premium. It always have to be at the nominal rate and no premium can be added to it. And the third statement is they can be issued at a lower than market price, which is wrong. Bonus shares cannot be issued at lower price than the market price. So the correct statement is only statement 1, which is given by option B. That's just going to be our answer. Okay, we have question number 16 now. We're given ordinary shares and the retained earnings of a limited company at the start of the year, and during the year different events took place. So the non-current assets were revalued upwards. All right, and then dividend was paid and a debenture is also there. Profit is also given. We only need to find the equity. Okay, so equity, we're just going to calculate it right away. So equity actually includes the ordinary shares, right? So this is going to come under this. Equity also includes the retained earnings. Now revaluation upwards. So this is going to be included in equity. So we're just going to add the revalued amount. Dividend paid. So dividend paid is actually deducted from the profit for the year, and that's going to be included in this. So I'm just going to add the profit for the year, 80,000, and I'm going to deduct the dividend amount, which is 30,000. But the debenture is not going to be included here because debenture is a non-current liability and not an equity. So our total amount is just going to be these 5 amounts, and if you calculate it, we'll receive 440,000, which is given by option C. That's the correct answer. Now we have question number 17. Oh, it's a lengthy one. Okay. We're given information regarding ordinary dividends. All right, we're given 2 years, 2019 and 2020, and we're given dividend proposed. Now this is a tricky one because dividend proposed is not the same thing as dividend paid. When we pay, or when a company pays a dividend, then there is changes in cash flows. There is increase in cash outflow, but when a dividend is proposed, there is no changes in the cash flows at all. So dividend proposed does not make any difference in cash. All right, now we have the information which says that the company paid last year's proposed dividend in full. So last year's proposed dividend is 12,000. So this is paid in full along with an interim dividend. So the total dividend paid, I'm just going to write it down. So the total dividend paid is going to be last year's dividend, which is 12,000, and an interim dividend of 4,300. So the total dividend paid is of 16,300. All right. Now, what is the amount of dividends shown in the financial statements for the year ended 30 June 2020? We're given 3 columns. The first one is income statement. Now, income statement does not record dividend. So income statement should not be having any value. So it's just going to be nil and nil. So these two are the correct options here. Statement of changes in equity actually records the dividend paid amount, and we've already figured out that the dividend paid amount is 16,300, which is given by the option A. So this one is the correct one, right? So these two are the correct one here. And for the statement of financial position, again, it does not record dividend, so it should be nil. So this and this are the correct options. So this is the correct one, which is given by option A. Okay, question number 18, we're given trade receivables turnover ratio figures in days. So company X has 45 days, company Y has 55 days. So what does trade receivables turnover actually mean? We're given it in days, right? So this just means that whatever trade receivables amount owed to the company X, it's gonna come to them within 45 days. But for company Y, it's gonna take 55 days for this amount to be received. All right. Now, what does this indicate about company Y? It has higher levels of trade receivables. That's not true, because it only gives the turnover in days. We're not talking about the value of the trade receivables here. So option A is just incorrect. Option B suggests that it has a higher liquidity in X. Again, that's wrong, because we're just figuring out the turnover ratios, right? And turnover ratios does not give any liquidity information. Those are given by the liquidity ratios. So B is wrong. And option C, we have it is less efficient in managing its receivables than X, which is actually true, because X is receiving those trade receivables amount within 45 days, but it's taking 10 days longer, right? So company Y has to wait 10 days more in order to receive the trade receivables amount, which means that it is less efficient. So option C is correct. Option D, we have it offers less credit. Again, we're not talking about any amount here. We don't know how much credit any company X or Y is providing, so we cannot conclude anything about it. So the correct option is going to be option C. Okay. Question number 19, we have company's non-current asset turnover ratio. So we're given the values over here, right? This is going to be revenue, because that's the formula for the non-current asset turnover ratio, and this is going to be the non-current assets. It's actually the net book value. Okay, now the net revenue was unchanged for the year 2020, which means the revenue is still going to be 2200, and then discount allowed increased by 400. This does not affect anything. Depreciation was 1000, which means that the net current assets value will be reduced by 1000. So net non-current assets net book value is going to be, so previously it was 5100. Now we have depreciation 1000, which needs to be reduced. And we also have purchases of non-current assets, which increases the value. So we're just going to add that over here. So the total non-current assets will be 5400 now. We need to find the non-current asset turnover ratio, which is given by revenue, which is 20,200, divided by the non-current assets, which is 5,400. So if you calculate it, we get 3.74 times, which is given by option D, the correct answer. Okay, for question number 20, we're gonna figure out which of these four statements are correct. Now, the first one is fixed cost per unit. We're not talking about total fixed cost, we're talking about fixed cost per unit. Changes with the change in the level of production. It's actually true. But if it were to be fixed cost or total fixed cost, that would not change. Okay, we have that in option 3 actually. So total fixed costs are unchanged within a given range of production, which is true, because total fixed cost does not depend upon the number of production or the range of production. So the statement 3 is also correct. Let's look at statement 2, variable cost per unit. We're talking about per unit changes with the change in the level of production. That's actually incorrect. If it were to be total variable cost, that statement would have been true, but it's not true for per unit cost. Again, for statement 4, we have total variable costs are unchanged. That's false. total variable cost actually changes within a given range of production. So this statement is incorrect as well. The correct statements are statement 1 and 3, which is given by option B. Okay, question number 21. An employee is paid $20 an hour basic pay for working 7 hours a day. Okay, I'm just gonna note it over here. So basic is gonna be $20 per hour. Overtime is paid at the rate of time and a quarter, so which is basic plus 25%. So overtime is gonna be 20 plus 25% of 20, so that's just 20 into 0.25. So that's 25 per hour. And we also have bonus. So bonus is also paid at the rate of time and a half, which means basic pay plus 50%. So I'm just going to calculate bonus as well. So bonus is going to be 20 plus 20 into 0.5, which is $30. So these are per hour, right? So I'm just going to write PH. So this is also per hour, but this is per unit. Per unit, but in excess of 8 units. So if the units are greater than 8, then we're going to charge $30 bonus as well. Now, the employee worked 10 hours. So for 7 hours, it's going to get the basic pay. And for the excess 3 hours, it's going to get the overtime pay. And we also have excess units. So greater than 8 units, which is 10. So the difference between these units is 2. And for 2 units, they're also going to get a bonus of 30. So the total value is going to be 275, given by option D. That's the correct answer. Okay, for question number 22, we have absorption costing and what will be included in the cost of sales. So cost of sales actually just includes the direct costs, right? Direct costs, which is actually manufacturing costs. And it includes manufacturing costs of both types, variable as well as fixed. Okay. Option A, we are given variable manufacturing cost, which is true. Variable selling cost, that's not true. That comes under the heading of selling and distribution costs, which is not included in cost of sales. But fixed manufacturing cost is included, but option A is wrong. Option C, we have variable manufacturing cost, which is true. Fixed manufacturing cost, which is also true. So option B is actually correct, but let's just look at option C and D as well. Variable manufacturing costs are included, that's true. Variable selling costs are not included, so option C is incorrect. Option D, we have variable manufacturing costs only, but there should also be fixed manufacturing cost. So this is incorrect as well. So the correct answer is option B. Now we have question number 23. A business absorbs its overhead on the basis of machine hours. All right. And the following information is provided. We are given the actual and budgeted information. We're given the overheads along with the machine hours of 6,200 and 6,000. So we can see that here the machine hours actually differ. And the actual is 6,200. So I'm just going to convert the budgeted overheads in terms of 6,200 machine hours. So the budgeted overheads per one machine hour is going to be 900,000 divided by 6,000. But if I need the budgeted overheads for 6,200 machine hours, I'm just going to multiply it with 6,200. So the total budgeted overhead now, it's going to be 930,000. Now we can see that the budgeted is actually less than the actual overheads. Now what did this result in? This actually results in the underabsorption. By how much? We're just gonna subtract the amounts. So 960,000 minus 930,000. So this gives 30,000. So we have underabsorbed 30,000, which is given by our option B. Okay, for question number 24, we are given information about 1 unit of a product, and we're given the selling price, contribution, and the profit. Now the selling price is expected to increase by 10. So selling price, there's a change, but costs are expected to remain unchanged. We need to find the change in the contribution to sales ratio. Okay, so I'm just going to do a before and after comparison. Okay, before the selling price was 100, but now we're increasing the selling price by 10, so the selling price is going to be 110. Now variable costs are to be remain unchanged. So previously the variable cost would have been 60, and it remains unchanged even after. Now let's just find the contribution. So these are all per unit, okay? So the contribution per unit is going to be $40, and the contribution per unit here, it's going to be $50. Now we just need to find the contribution to sales ratio. So contribution to sales ratio is just going to be contribution by sales. So here we have the contribution of $40, sales is of 100 into 100, so that's just going to be 40%. And here the contribution is 50, the selling price is actually 110 into 100, so this is percentage. All right, okay. This is 45.45%. Now what's the increase here? So we can see that previously it was 40%, the ratio was 40%. Now it's increased to 45.45. So the increase amount, or the increased percentage, is actually 5.45%, which is given by option D. So that's our answer. Now question number 25, we're given unit selling price, direct cost, selling commission, and total fixed cost along with total units manufactured and sold, and we are to find the margin of safety. All right, in order to find the margin of safety, we first need to find the BEP. So I'm just going to figure the BEP in units. So BEP in units is going to be total fixed costs divided by contribution per unit. So contribution per unit is just going to be selling price minus variable cost. So direct cost per unit is also a variable cost, and the selling commission per unit is also variable cost. Why is it a variable cost? Because we're given per units. So if 1 unit is sold, the selling commission is going to be 2. If 4 units is sold, the selling commission is going to be 8. It's going to change according with the amount of goods sold. All right, so the BEP in units is going to be 1,250 units. So the margin of safety, I'm just going to write MOS in units. It's going to be the total units manufactured and sold, which is 18,000, minus BEP in units, which is 11,250. So the margin of safety in units is just going to be 6,750 units. But we are given the margin of safety in terms of percentage. So I'm just going to convert this into the percentage. So in terms of percentage, it's going to be margin of safety in units, which is 6,750, divided by total units manufactured, which is 18,000, into 100%. So that's going to be 37.5%, which is our answer A. All right, for question number 26, we need to find the formula for BEP revenue. So BEP revenue is just going to be BEP in units, which is given by fixed cost divided by contribution per unit into the sales revenue, or it can also be written as fixed cost divided by contribution to sales ratio. So we're just going to find this or this. So option A is given total fixed cost plus total variable cost. This is wrong, so it's incorrect. Option B also has the same thing, which is incorrect. Option C has total fixed cost divided by contribution per unit. This gives the break-even point, but it only gives the break-even point in terms of units, and we're required in terms of revenue. So this is also going to be incorrect. And the last one is total fixed cost divided by contribution to sales ratio, which is this formula, and it gives break-even revenue. So the correct answer is option D. Alright, this is a lengthy one as well. A business manufactures 3 products. We're given X, Y, and Z, and we're given various information. So I'm just gonna go directly to the question. So the direct labor is in short supply. Whenever there's a short supply, we rank in accordance to the priority, and all the direct labor is paid at the same hourly rate. In which order of production should be used to maximize the profit? It just means that we're going to have to rank it. So whenever we're going to rank, we always need to find contribution per unit divided by the thing that's in short supply. So the thing here is the direct labor. So I'm just going to divide contribution by direct labor. So for X, Y, and Z. X, Y, and Z. For X, it's going to be 175 divided by 115. So this is going to be 1.52. For Y, it's going to be 155 divided by 95, which is going to be 1.63. And for Z, it's going to be 60 by 190, which is going to be 0.32. So we're just going to rank, and whenever we're going to rank, we're going to do it in a decreasing order. So the highest is of Y, right? So it's going to have the first rank, and the second one is 1.52 for X, that's going to come second, and the last one is Z with 0.32. So our order here is just going to be Y, and then X, and then Z. So if we divide direct labor in this order, then we can maximize the profit. So we're just going to look at this. It's given in option C. That's the correct answer. Okay, question number 28. We're given the selling price and contribution per unit, and we're also given the total fixed cost and the budgeted sales. We're also given that the directors think that if they reduce the unit selling price to 95, sales will increase to 6,500 units. So previously the sales were 5,000 units, and with the reduction in selling price, it's going to increase to 65,000 units. All right, I'm again going to do the before and after thing. Okay, let's start with selling price. So previously the selling price was 100 per unit, and we're going to reduce the selling price to 95 now. Then the variable cost. So for previously, selling price is 100 and contribution is 30, which means that the variable cost is going to be 70. Okay, now there is no changes in variable cost, so it's going to remain the same after as well. Then we're going to calculate the contribution. So contribution is going to be 30 and 25. So number of units, previously there were 5,000, and it's expected to increase to 65,000 now. So I'm just going to calculate the total contribution now. For total contribution, we're just going to multiply the contribution with the number of units. So this is going to be 150,000, and this is going to be 162500. Okay, we need to find the increase in profit. So in order to find profit from total contribution, we just need to reduce the fixed cost. So profit, 1,50,000 minus 1 lakh, that's just going to be 50,000. So profit was 50,000 before, and now it's going to be 62,500. So there's an increase. By how much? So the increase is actually just very easy to figure out. We're just gonna subtract this. So the increase is of 12,500 which is given by option A. Alright, question number 29. A business makes and sells a single product and it has a selling price of 100 and a contribution per unit of 40. Okay, selling price of 100 and contribution of 40. And when the output is 500 units, the business makes a profit of 2000. And the direct material price is expected to rise. I'm just going to do the before and after again. So before, the selling price is 100. After, it's going to remain the same. The variable cost before is going to be 60. But we are given that the direct material price is expected to rise. So it means that the variable cost will rise by 4, which is 64 now. Then the contribution is going to be 40 and 36 per unit. Okay. We're also given that when the output is 500 units, the business makes a profit of 2000. So when the output is 500 units, which means that we're just going to need to multiply it with the contribution per unit minus fixed cost, that gives us the profit of 2000. Then the fixed cost is just going to be 40 into 500 minus 2000. So we have the fixed cost of 18,000. Okay, now we need to find the number of units that is needed to be made and sold for the profit to be unchanged. So we still want the profit of 2000. And we have the contribution of 36. And the number of units, I'm just going to denote it with X minus fixed cost. Fixed cost is 18,000. That's not going to change with change in levels of units produced or sold. So it's a simple equation now. So it's just going to be 2000 plus 18,000 divided by 36. So the number of units is going to be 555.56. If we round it off, we get 556 units, which is option D. Let's move on to the last question of this set, which is question number 30. Now, what is not an advantage to a business of preparing the budget? So we just need to figure out which one is the incorrect one. So they can motivate managers and employees. This is definitely true. When you prepare a budget, you're kind of setting the goals for managers and employees, and when they have a certain goal that they need to achieve, it somehow makes them motivated. So option A is actually an advantage. Option B, they ensure that the business will not make loss. That's not true. They cannot actually guarantee it, but budgeting is just a plan, right? And anything can change. Maybe the sales numbers will go down and business can actually incur a loss. So this is not ensured by a budget. So this is not an advantage. We're also going to look at options C and D. They facilitate coordination and communication. Again, budget sets a certain goals for everyone in the business, and in order to achieve those goals, it's very necessary to have coordination and communication among each others. So this is actually an advantage to a business of preparing budgets. The last option we have is they provide a measure for evaluating performance, which is absolutely true because we're setting some kind of goals, right? So we can actually measure and evaluate their performance. So this is an advantage. So the correct answer is option B. So that's all for this set. If you think that this video was helpful for you, make sure to leave a like below, leave a comment, and subscribe if you want to view more of these videos. Thank you.